Good afternoon, everybody. Welcome to today's second live event at ibkrwebinars.com. Gareth Ryan joins me today. He's the founder and managing director at IUR Capital. How are you, Gareth?
I'm doing very nicely, Andrew. Looking forward to the year ahead.
Well, you've really picked the topic for today on a big down day for the market, at least to begin with. What are we going to be talking about today, Gareth?
Yeah, so volatility, that's what we see across our trading screens today. As everyone listening in will see also. So volatility is the topic of today, and yeah, I guess the timing couldn't be much better when we've had such a rough start to the year for equity markets.
Yeah, just making you an organizer there, Gareth, so you can see any questions coming in. Folks, this is a live event, so please do type your questions into the chat panel for Gareth, and he'll either get to them throughout the session or we'll do a Q&A at the end. And on the screen, Gareth has just displaying the disclosures. Since we're talking about risky types of products, it's important that you're aware of the type of content we're going to be discussing. So please take a moment to read that. And I guess, what else do I need to tell the audience? The handouts from today's session are available by expanding that arrow next to the handouts topic, or panel rather, in the GoToWebinar software, so you can follow along. Or I know Gareth does a great job in keeping the slides up to date. So Gareth, if you want to move on to your opening slide, I'm going to go on mute, and look out for the recording link, folks, a couple of hours after Gareth's wrapped up today. Gareth, take it away, please.
Okay, great. Thank you very much, Andrew. And firstly, a very happy new year to everyone who is joining us for today's webcast with our friends at Interactive Brokers. You should see the cover slide on screen. That's volatility strategies for a volatile market. And yes, the timing couldn't be better with regards to volatility, as many of you will see. We're going to be talking about options pricing and volatility today, and what it means when we see the equity market down 3-4% in the first few days of the year. This event is being recorded, as Andrew mentioned, and we will leave the questions panel open for everyone. I can see we have some folks just joining us. Better late than never. The questions panel will be open throughout. If we don't get a chance to answer your questions, then we hope to do so after the live event itself. Now, we have our own risk disclosure that we need to get through for everyone. I know some of you have been to our webcasts before. Folks, in December, we had almost 2,000 of you register for our webcast with Interactive Brokers. That was an options-based webcast as well. But regardless of whether you have been to any of our previous events before, or this is your first webinar with myself, I would ask for your full attention for this particular slide. Options are leveraged products that involve risk and are not suitable for all investors. Before you commit your capital to any option strategy, please ensure you've read the characteristics and risks of standardized options provided by the Options Industry Council. You can obtain a copy of that document on that link. IUR Capital is an investment advisor registered with the Securities and Exchange Commission in the US, and also we're a registered portfolio manager with the Ontario Securities Commission in Canada. We're also authorized and regulated by the UK Financial Conduct Authority as an investment advisor. We do not hold any client funds. Client accounts are held at a FINRA regulated broker-dealer and clearing firm. Certain individuals of IUR Capital are FINRA registered representatives of our affiliate broker-dealer. None of the content in this presentation carries an offer or solicitation of an offer to buy or sell any security or operate any specific strategy. Any securities in this presentation are for illustrative purposes only, but are not intended as recommendations. Where we talk about multiple leg strategies, that includes combos and spread strategies, the commission is per leg, and therefore multiple commissions will apply. Commissions are, of course, subject to change. The information provided in this presentation is believed to be accurate, but the accuracy and completeness of the information is not guaranteed, and investors should not rely on any information for the maintenance of books and records or for tax, accounting, financial, or regulatory reporting. And lastly, past performance is, of course, not indicative of future results. Now, it's always a good idea to know who you're listening into on the other side of your meeting today, and that is, of course, myself. I'm the founder and managing director here at IOR Capital. As I mentioned, I set up IOR Capital Limited in the UK in 2007 and in the US for our US clients in 2010. We are an investment advisor for both retail and institutional investors with a focus on the use of exchange traded option strategies in portfolios, our client portfolios that we advise and manage, many of which are on the Interactive Brokers platform. Now, it's important to notice, folks, that with this particular slide and the upcoming charts that we're looking at, they were prepared at the beginning of last week, just before things started to kick off with this broader market decline. So yes, we are negative for the year for the major indexes. The S&P is down 3.5% in the first 6 trading days of the new year. In fact, last week, the first week of the new year, that was the worst week the worst start to the new year for the S&P since 2016. Meanwhile, the declines in the NASDAQ, they are really what we, of course, should be looking at, because the broader declines in the market are being driven by the sell-off in technology stocks. The NASDAQ's down more than 6%, and we are heading quite quickly towards that 10% correction territory. Other areas like small caps are also starting the year on a weaker note. The IWM, that's the Russell 2000 index, is down more than 4% for the year. The Dow Jones Industrial, however, is holding up relatively well. It's down less than 2% for the new year as a whole. Okay, so with that in mind, let's remind ourselves that we've just come off the 3rd consecutive year of gains for equity indexes. The S&P did 27% last year to follow up on the 2020 performance. Yes, of course, 2020 was exceptional in terms of the market swings that we had, but the trend over the past couple of years remains to the upside, firmly to the upside. It's being driven by technology stocks last year. It's also being driven by commodities in 2021. Take a look at energy stocks and you'll see exactly what I'm talking about. Oil had a significant year last year, along with other areas of the energy sector. So all of that demand is, of course, saw quite a significant move higher for the S&P over the past 12 to 24 months. The volatility index, which we'll talk about during today's event, of course, although it is off its lows of around 16, it's trading today around the 22 handle, up 17% on the day. But of course, that's significantly lower than where we were trading in the VIX in March of 2020. So again, all of these points, they were prepared before we started to see this sell-off. One thing we haven't mentioned on our market update today is, of course, what's going on with the 10-year Treasury yield. Folks, it's unfortunate that when we talk to retail investors, some of them may be overlooking the fact that when the yield on the 10-year sells off consistently, we're talking several days in a row, then there's a broader market shift taking place. And over the past few days, as we saw a sell-off in treasuries, the yield on the 10-year has started to break above 180. If we see a 2% yield on the 10-year, that will put further pressure on risk assets, and in particular on growth names within technology in particular, because of course those growth names some of them are not profitable for a start. Secondly, they're not paying a dividend, and they will be exposed to a change in the interest rate environment, which of course is going to be, I think, one of the main stories of 2022, and how much of an impact a series of rate hikes by the Fed will have on risk assets, of course, including equity markets. Okay, so that's what we're going to talk about a little bit later today. Let's first and foremost get through our charts. Folks, we'll talk about the VIX first and foremost because I think it's a good place to start. Remember that when we're talking about options pricing and the options market, what are we really talking about? We're talking about the volatility index. and we're talking about volatility more generally. Remember that the volatility index is not a broad market fear gauge, folks. It's specific to the S&P 500 index. So SPX options, the 30-day implied volatility of those SPX options, that's what we're looking at when we look at the moves on the VIX on any given day. So as I mentioned, we've had a sizable move higher today. Remember that around 70 to 80% of the time, the volatility index, the VIX, will move inversely to the SPX. And of course, with the SPX down almost 2% at its lows today, that of course saw that significant spike higher in the VIX to start the new week. Now, this is a 1 year on the volatility index. While we've had this spike in the VIX over the past few days, it's important to look at what happened in prior occasions. What can we see when the VIX has previously saw these near-term spikes? Well, as I mentioned, a VIX at 22 is still near the lower end of the average over the past 1 year. If we take a look at what happened in late January of 2021, we can see that when the VIX went to 37, there were other factors at work, other forces at work in the market. And of course, back then it was the meme stock mania and more broadly retail trading mania that contributed to exacerbated market moves in a small number of stocks that were driving broader market sentiment. That spike in the VIX, when we went to 37, look how quickly we retraced back below 30. Within a matter of days, we were back below 30. And then we went back to the mid 25s a few days later. It didn't last very long when we have that spike in the VIX. Once again, later in the first quarter, in mid-February, we had a sell-off in treasury yields. Okay, here we are almost 12 months later, and the exact same thing is happening. We have a sell-off in treasuries. Yields are spiking, particularly on the shorter duration, long duration to some extent as well. And we have a spike to the 29-30 handle. So a smaller spike, a smaller peak as such in the VIX. We move out to the month of May, and yet again we have another spike in the VIX. Once again, it's short and sweet to that matter. It lasted a couple of weeks at most. Then when we go out to September of last year, we have a sell-off in the NASDAQ. Once again, we have a sell-off in the NASDAQ to start the new year. But once again, it's a smaller peak. We did not break above 30. So that's the first 4 peaks in the 2021. I guess the larger peak and the volatility spike was before the Fed meeting last month. Folks, we had some broad market jitters going into that Fed meeting in the 3rd week of December, where there was concerns about how hawkish the Fed would be during its press conference. And Fed Chair Powell, I guess, turned around the market on his own when we sold off on the Monday and Tuesday going into the Fed meeting. Then on the Wednesday of the Fed press conference itself, we rallied sharply and the SPX closed above 4,700. So it was a sizable move intraday for volatility. Immediately after the Fed meeting, what do we see? Once again, a very sharp retracement to the downside from 32 all the way down to 19 in the space of just a few days. We continually move lower, albeit with a smaller peak towards the end of the year. And in fact, we ended the year almost at its 1-year lows for the volatility index. So what can we take away from the 1-year action on the VIX index? Well, it's very simple. Every time we have a VIX spike, it is met with almost an immediate retracement to the downside. So if you were dealing in VIX options, folks, and you were thinking, okay, well, you know, we've had this quite nervous start to the year. Things are looking pretty ugly for the NASDAQ, down almost 7% for the year. Are we going to see another move lower for the NASDAQ? And of course, that will see another move higher in the VIX. Or will we see things gradually stabilize over the coming days? Well, we've got a lot to keep on our plate. Remember, we've got earnings season beginning next week, and then we have another Fed meeting at the end of this month. And between now and then, we will see continued moves in the Treasury market. So I would make a suggestion to all of you over the next few days, if you're looking at your screens and you're looking at what's going on with the indexes, that's one thing, and that's what you do on a day-to-day basis, particularly if you're near term with your time horizon. But you should start to be following, if you're not already following, the moves in the 10-year Treasury, because that is where we will see most of the action before the next Fed meeting. If we see yields start to stabilize, then that should feed through to risk assets, including equity markets. But that's one thing I would suggest to retail investors, folks listening into today's webcast. Let's move on to SPDR. We know that SPDR, of course, is the largest and most actively traded index ETF on the market, and of course it tracks the S&P 500. This is the 1 year, as I mentioned, we had a 27% return for SPDR last year. I did put a comment that there was more upside in the first quarter of this year. There is certainly potential for more upside, but of course we are starting off on the back foot, and of course that's been driven by what's been happening over the past few days. Any correction in 2021 was somewhat short and shallow. I believe we did not have a 5% correction throughout the entire year based on our peaks and troughs in this particular chart, this 1 year chart. It is certainly possible that we will have a correction beyond 5% in the first part of 2022, particularly as we are already 3.5% lower for the year. So just bear that in mind with regards to SPDR, and of course also bear in mind the implied volatilities on SPDR. On the bottom of your graph, you can see that we did hit the peak once again for the volatility in the very final few days of the year. Of course, that was based around that Fed meeting, but we closed near the lows for the volatility index. So there are things that are taking place in the broader market as we speak today, and of course over the next few days. This rotation out of growth into cyclicals, into quality, that's something that may take another few days, perhaps another couple of weeks or longer to play out. And of course, that may mean that we have some further declines in the major averages. Lastly, on the Qs, once again, a very actively traded index ETF. We can see what's been happening over the 2021 period. Unfortunately, I have not had the chance to include what's been happening over the past few days because we have tested the 370 handle down here on the Qs today, with the declines extending beyond 2%. But the volatility of the Qs down here, folks, the volatility in the Qs will be higher than what we've got with SPDR for obvious reasons. But as you can see, over the past 12 months, the trend has been firmly to the upside. The NASDAQ and the Qs will suffer more than the broader market with this move out of growth into cyclicals. Again, it may not be a permanent trend or a change in trend, but it is something that's going to impact day-to-day sentiment over the next few days and weeks. Okay, so with that being said, let's think big picture for a moment about Q1 and what we need to be thinking about in the first quarter. As I mentioned, we've got earnings kicking off next week. There will be some surprises. There always is surprises around earnings, folks, but it's going to be interesting to see what the majors are telling us about their outlook for growth and for earnings in 2022. How big of an impact is the pandemic, and more specifically Omicron, having on their growth potential over the next 6 to 12 months? Earnings may be solid for the Q4 period, but it's what we're looking at in terms of guidance over the next 12 months. That's going to be interesting. Of course, inflation and interest rates, those are, as I mentioned, the driving force for what's happening with these declines today, and as I mentioned last week. Keep an eye on the 10-year yield. Think about what inflation is doing. Folks, inflation is now growing at its fastest pace in several decades, not just in the US, but overseas. That's reflected in the fact that energy prices have surged in the past 12 months. So that will inevitably lead to inflation. And that's one of the reasons why the Fed is looking to bring forward its rate hike program. Not too long ago, we were pricing in the first rate hike in the summer of 2022. Now it appears that it will take place perhaps as early as the March meeting. Therefore, of course, as I mentioned, risk assets need to price that in to their outlook for the rest of 2022. Now, we have just one question of the day for everyone listening in, and it is quite a simple question. And as I've mentioned, we have a significant move in the volatility index today and over the past few days. But let's look at the 12-month period, and let's ask ourselves, will we see the VIX break above 40 in 2022? So once again, the question for everyone is, will we see the volatility index break above that 40 handle, which was a significant spike on the last occasion that it took place? You can put your answers in the questions panel, please. Once again, it's a 12-month outlook for the volatility index. And bear in mind, if we were looking for the volatility to continue to move to the upside, that's where we could look at being perhaps a buyer of out-of-the-money VIX calls or perhaps even VIX call spreads. That lets us participate in the next move higher in the VIX. Once again, we have an 18% gain today in the volatility index. So it's a sizable move higher, but at a 22 handle for the VIX, it still remains near the lower end of the average for the VIX over the past 1 year. Let's also remind ourselves, folks, that when we buy puts, we're buying volatility. When we're selling puts, we are selling volatility. So it looks like most of you are coming in with your answers here in the questions panel. Let's see, most of you are saying yes, we will see a break above the 40 handle in 2022. Think about it this way. We could have several occasions where the VIX breaks above 40. We could have a test of the VIX at 30 in the next couple of weeks, particularly with that Fed meeting coming up at the end of this month. So we need to think about that when it comes to the near-term outlook for the VIX. Are we going to retest 15, the lows from last year? Well, the trend looks to the upside for the near term. So we need to think about how we can participate in that. We can take a long volatility position where we're buying volatility. And as I mentioned, we can do that through those VIX options. We can be a buyer of outright VIX calls, or perhaps even a buyer of outright VIX call spreads for a different risk return profile. So let's move on to a more general discussion now, okay, with regards to volatility strategies in comparison to income seeking strategies. On our December webinar, we spoke about typically income seeking or premium harvesting strategies, which are there to essentially generate a premium where we have a trending market. The trend for the market right now, the broader major averages, is to the downside in the near term. So we need to think about that when we're using one or more option strategies. Remember, we can be an upside buyer of options, we can be a downside buyer of options. Okay, we can be an outright buyer of upside calls on indexes if we think that this near-term sell-off is overdone and that we will bounce off these lows. Or we can be a buyer of the downside, and that is where we're looking for an extended move to the downside. Remember that 4,500 is around the lows, the December lows that we saw. And we're not too far away from that now, folks. We're just 2% away from the 45 handle. So volatility strategies. Over on the right, we've got the straddle strategy, the strangle, and of course, the long put. We can talk about those in a bit more detail in just a second and what they will do for us. But let's also give ourselves a reminder of what it means to be long vol or short volatility. So as I mentioned, when we're buying put options, we're buying volatility. When we're selling put options, we are, of course, selling volatility. So let's take a look at the strategy breakdown using Vega as our option Greek, of course, to measure the change in the value of the option relative to the change in the volatility. So if we're buying a call option, any increase in the volatility, that means we're long Vega, should benefit our long call position. Any decline in the volatility will likely impact our long Vega position. Whereas if we're selling call options, well, we're short Vega, and any increase in the volatility will likely move against us and our position. Of course, if there's a decrease in the volatility, that should benefit our short call position as a whole. Of course, other factors bearing in mind. If we're buying put options, as I mentioned, we are long volatility. If I'm buying put options early last week, folks, well, hindsight is a wonderful thing, but if we were buying put options on, the Spider or the SPX when we were making those opening highs of the year, and I held those throughout the past few days, those would have moved sizably in my favor as the put options increased in value. Because of course, along with the fact that the market has declined, we've had this increase in the volatility. So that benefits your long put option. Of course, put options are expensive, relatively speaking, when we have a high volatility. And they can very quickly move against you if we start to see equity markets bottom out. So we need to think about that as well. On the other side, if we're a seller of put options, if we're short put options, of course, that means that we're short the Vega. That means we're negative Vega, of course, and we need to think about that because, of course, if we're thinking to ourselves that, okay, we've had this near-term spike in the volatility, but the broader long-term trend remains relatively neutral for us, then we can still be an outright seller of put options, but we need to understand the risk that there may be another move higher in the volatility and, of course, a move lower in those indexes, which would adversely impact our short put option. So that's on those single leg strategies. What about on the spreads? Folks, as many of you will know from our previous webcasts, we are an advocate of spread strategies for a very simple reason. With spread strategies, we have a defined risk, defined return scenario for our portfolio. For our clients that we advise, we typically advise not to deal in unlimited risk option strategies. Of course, that includes the naked call option or naked put options for that matter, okay, which are not secured by cash or otherwise. So we need to think about how we're going to use defined risk, defined return strategies, because we know when we are a seller of a spread strategy, we know what our maximum return will be. It will be the premium that we received. Whereas if we're a buyer of a spread strategy, the maximum we can make is the value of the spread itself, the maximum value of that spread. And the maximum risk, of course, being the premium that we paid out. So let's take a look at our spreads and our combos and the risk return. Folks, if I'm a buyer of a strangle or a buyer of a straddle, I need a volatility move. I'm going to be buying volatility. I need to see a move in either direction. If we get a substantial move in either way, to the upside or the downside, then my long strangle, or for that matter, my long straddle, should make money for us because, of course, the implied volatility is increasing. And remember, we are long volatility. We're long Vega, we're positive Vega, I should say, with either a strangle or a straddle position. The rise in the implied volatility will work for us. Whereas if we have a decline in the implied volatilities, then the value of that straddle or strangle for that matter will decrease, and that will negatively impact our long position. So it's not always appropriate to be buying straddles or strangles. Typically, folks, in a trending market, the volatility is somewhat range bound, and it will be more difficult for us. The opportunity will be more narrow in terms of making a profit from being a buyer of a strangle or a buyer of a straddle. But we'll look at those two setups in just a moment. Let's take a look at those spreads, the credit spread and the debit spread. Of course, the credit spread as a vertical spread strategy will have a short Vega profile. Any decrease in the volatility will work in our favor. Any increase in the volatility, like what we have saw over the past few days, will negatively impact that vertical spread. Okay, on the upside, on the debit spread side, that's where we're buying spreads, either buying a put spread, for example, then that should result in a long Vega position, a positive Vega on the overall setup. So any increase in the implied volatility will work in our favor. Whereas, of course, any decrease will negatively impact the spread. So we need to think about whether or not it's appropriate to be dealing in these spread strategies. Timing of entry is, of course, important. It always is with option strategies and the type of option strategy that you're using. Folks, there are times where there are situations we believe where it's just not appropriate to be a seller of volatility. Some of you have in previous webcasts said to us that, okay, we don't want to be selling volatility below 15 on the VIX because the risk return scenario becomes too narrow and it's not attractive for us. Well, that's certainly a valid point, but think about the period where the VIX has traded between 15 and 20. That period could last several weeks, and within that period there are opportunities to be short Vega with some kind of protection to mitigate your volatility risk. So we need to think about that as well, that there are certainly opportunities when we have a low volatility VIX to be buying volatility, but likewise on the upside, where we form the top end of the range, and that's where we perhaps want to look at the VIX topping out in the near term. So all of these things we need to think about with our timing of entry. Remember, taking a volatility position, in some cases, folks, it's got less to do with market direction. You are more focused on what the volatility is doing than broader market direction, and whether or not you can benefit from that in your overall setup. Now, these potential volatility strategies, the straddle and the strangle. Well, let's take a look at what we're doing here. Remember, it is somewhat speculative in nature. Taking a volatility position, you are speculating on what the volatility is going to do. You're looking for a higher or low volatility. That's quite simple. If I'm a straddle buyer, as I've mentioned, we're expecting higher volatility. If we're a straddle seller, then we're expecting a lower volatility. Stranglers are, of course, expecting a similar movement, but they have a different risk return scenario, and we'll take a look at that in just a moment. Let's take a look at the long straddle. Quite simply, folks, you need a movement one way or the other. It's a very simple V in terms of my risk return profile. If I was to draw you on a chart what the long straddle looks like, it is a very simple V. You start off at the very bottom point on the V, and to the left is your put, and to the right is your call option. You need a movement above a certain level either side. If I'm buying a call and buying a put, my risk profile is very simple, with the same strike price underlying an expiration. My maximum risk will be the debit that I pay, and the maximum return, well, that's potentially unlimited, folks, either side, to the put or the call side. The downside break even is very simple. That is the strike less the net debit. My upside break even, well, that's simply the strike plus the net debit. So we need to think about where is it appropriate to be buying a straddle. On our previous events where we've talked about buying straddles, many of you will say, well, what about earnings season? That's certainly one opportunity for us to be buying volatility around earnings on a single name if we think that there's going to be a sizable move one way or the other. So that's something to consider. But in this case, we're talking about a broader market volatility move, such as, of course, what we're getting today to start the new week, with the S&P heading towards a 2% decline, the NASDAQ down almost 2.5% on the day. So a long volatility position in today's market sell-off would be moving in your favor. Of course, if you have a long equity portfolio, folks, well, that's taking an impact today. So they may play out, they may even out, or there may simply be a mitigation of your risk on long equity portfolio. Okay, now let's take a look at our example. We've got our underlying security at $50. We're long the 50 call at 320, and we're long the 50 put at $3. So our net cost is around $6.20, or $620 to be long this 50 straddle. Okay, that's what we're paying for one of these. Now, of course, we can decide what position size we wish, depending on our portfolio and how much of a long volatility position we'd like to have. Now, let's take a look at our stock price along the left and what potentially happens to our P&L position. So we start off around the 50 handle. We can see that if we remain around the 50 handle, both the call and the put will start to move against us. Remember, folks, when you are an option buyer, you own a wasting asset. It's losing time value every day. Time decay is working against you. So you need something to happen. You need something to happen with that underlying price move. In this case, we need something like a 10% move or more. If we have a 20% move and we have the underlying stock at 60, then that long call is going to make money for us. The put option, however, is going to work against us, but we still have a net profit. Okay, in this case, it's around 380 on the long straddle. Meanwhile, on the downside, remember folks that we can make money both ways here. The long straddle will make a P&L if we have a move to the upside or the downside that's significant enough to increase the value of the overall straddle. So if we decline 20% on that underlying security, we're at the 40 level. Well, that call is of course going to lose most of its value. The put option, however, that's going to work in our favor. So in this case, our P&L is going to be made on the downside at the 40 handle. Of course, the problem for us with this straddle is very simple, as you can see. A 10% move is a sizable move either way, but in both cases, to the upside and the downside, we would still be looking at a loss on the overall long straddle. So we need to think about how big of a move we're expecting. If we're a buyer of that 50 straddle, well, we need to see a move essentially above 55 for this to start to become interesting to us in terms of P&L, or to the downside below 45. Okay. Now, Frederick is asking, is there an ETF tracking the VIX index? Well, folks, there is a couple of volatility products out there. Of course, you can look at UVXY or VXX for that matter. Those are two of those ETFs that you could consider owning, whether you want to be long or short the volatility. But as I mentioned, folks, you can obviously simply take an outright option position on the VIX index options. That is the most simple way to be trading VIX volatility. Now, let's get back to our long straddle P&L example here. Folks, we're looking at an initial stock price of 50. So if we get to that 60 handle and we get that 20% move to the upside, this is going to take place over about 30 days. We were 60 days out initially, and now we're 32 days out to the expiry. We can see what the long call is doing, and we can see what the long put option is doing. And we know that in the case of a 60 print for the underlying, that's going to work for us, that long call, okay? Whereas if we get a downside move, we simply flip it around. The put option will go to work for us, and the call will move against us. But we need to think about the big picture and the overall P&L on our straddle. Remember, we paid $620 for this. It's now sitting above $1,000 for that long straddle. So as long as we have a move that's significant, 20% in this case, then we should see a nice gain on the overall long straddle. It's something that we need to think about in terms of the premium that we're paying out, because as I mentioned, we're owning a wasting asset. Each day that goes by where we do not get a significant move in the underlying, that is going to work against us. Our time value is going to erode, and we need that move to happen in order to make a P&L. Okay, let's move on to the long strangle example. Once again, we have our underlying at 50. We're being a buyer of the 55 call, and we're being a buyer of the 45 strike put. The net cost in this case being $2.45. That long strangle, that long 45.55 strangle, we've paid about $2.45. So a much lower capital outlay. Okay, the debit to us is lower, but we need to think about what our P&L scenario will be. In this case, we can see first and foremost that the potential for us to risk the entire debit paid is over a wider price range. So in the case of a 55 or a 45 handle on the underlying, we would be risking most of our P&L, most of our premium. In this case, that $2.45 would be at risk. We need to see a move above 55 towards 60 or below 45 toward 40 in order to make a gain on the overall strangle. So we need to think about that and which of these two strategies is going to work for us. Let's take a look at a comparison here. Okay, it's always a good idea to get some perspective of what we're looking at in terms of premium overall and the premiums we're paying out in this case. The strangle, the max loss is possible over a wider range than the straddle. The straddle, the max loss is only if the stock is equal to the strike price at the expiry. The combination, that combo, the max loss is going to be anywhere between the two strikes at the expiry. So we need to think about this when it comes to, well, our general view on volatility. As I've mentioned, volatility is dynamic. It continually changes. The problem for many investors out there is that once we get the volatility move, then they react. No, that's taking a reactive approach to being long or short volatility. What you want to be doing is looking at your volatility range, okay, and looking at where we think we are bottoming out on the volatility, and we could perhaps look at an upside long volatility position, or where we have a near-term spike of the volatility and we see potential for a downside reversal, okay? That's what we need to look at. What I'm going to do in just a moment, folks, I'm going to bring you into the Trader Workstation. We'll take a look at the VIX and potential option setups, so we get an idea of what we're talking about with long volatility and short volatility. Before that, let's remind ourselves of the 4 things that we consider building blocks for using option strategies in the portfolio. Market conditions are a very important part, particularly on a day-to-day basis. Many of you retail investors out there are using weekly options, near-term weekly options. Therefore, your time horizon is very near-term. You're not concerned about what happens 3 months from now. You're focused on what happens over the next couple of weeks. And that's where your exposure to day-to-day volatility will be amplified. And you need to think about day-to-day market swings. So as I've mentioned, we've started the new week off sharply lower for the SPX and for the broader major averages to follow up on last week's declines. We need to think about whether this will continue over this week and into the following week. We have our traditional monthly option expiry coming up next week. We also have a 3-day weekend coming up in the US. Time decay works in our favor if we are a seller of option premium. For example, if we were a seller of a put spread, then time decay will mitigate some of the impact if we're selling near-term option premium. So we need to think about that as well. Strike selection. Well, strike selection feeds through to your appetite for risk, folks, because if you're selling option premium, once again, you're selling volatility with the expectation that volatility is topping out. But if you're selling near-term, close to at the money premium, your strikes will be more impacted by sharp market moves like what we're seeing today. Whereas if you're going further out in your time horizon, you can allow day-to-day market volatility to a much larger extent without immediately having to adjust your positions. Now, of course, one of the questions we get is, with the credit spread, if we're selling option premium, how do we manage our risk? Well, folks, many of you will know from our previous webcasts that we actively hedge our short volatility positions. If we're selling out of the money put spread premium on the Qs or on the IWMs or on the spiders, then very often we are hedging them to varying levels. For example, today we have been advising our own clients to be taking out some near-term hedges over the next couple of weeks with the expectation that we will retest those December lows. So although any bull put spread strategies on these indexes would be moving sharply against us today, we're seeking to mitigate but not eliminate our downside risk with these near-term hedges. How do we hedge bull put spreads? Very simply, you can go out and you can be a buyer of at-the-money puts, or you can be a buyer of at-the-money put spreads, each of which will provide different levels of downside protection. What about underlying security? Well, many of you will know that we are focused on index products. Typically, we're not in the business of single name stock picking. So that's where we like to have a basket of underlying names. Index ETFs, sector ETFs, for example, that would be our primary vehicles to use when we're taking long or short volatility positions. But of course, when we have sizable moves like that, what we have today, some names which are down more than 20% from their highs start to come into our attention, and that they should also come into your attention as well. When we have names, single names, enter bear market very quickly, then that's something that you should be keeping an eye on. So perhaps use some of the filter tools within the platform to identify names that are more than 20% from their recent highs. Lastly, time horizon. Well, as I mentioned, folks, you can be near term or you can be long term, or you can be both. You can have a blended approach where you take some near term exposure with a near-term sell-off, but your longer-term view for the market, let's say over 2022, still remains relatively positive. For example, one of our discussions recently with a client was whether the SPX would touch the 5,000 level. Will the S&P test 5,000 during the first half of this year? Well, of course, with a 4% decline from the highs last week, we are moving further away from that. But again, this is near-term uncertainty. These are near-term moves. The longer-term trend perhaps looks something different when we factor in the fact that we will have at least 2 to 3 rate hikes this year. So that's a more general discussion on the indexes, okay, and our expectations for this year. What I will do very quickly is I'm going to bring you into the Trader Workstation window. And let's take a look. I'm going to share another screen with you in just a moment. Hang on a second. This is going to be a chart that we're going to look at on the VIX very briefly, which is more recent to the broader market after the past few days. Okay, so let's take a look at this. Andrew, I'm going to share the charting window.
We're not seeing it currently, Gareth.
Okay, one second. Okay, I'm bringing it up on the screen.
We're still seeing the PDF.
It should see, one moment. Okay, we should see the chart window now.
Got it, well done.
Perfect, so this is the 1 year, folks, on the volatility index. As I mentioned, it's more recent given the fact that we've had this spike in the volatility over the past few days. So we bottomed out around the 17 handle at the beginning of last week. And now we are, as I've mentioned, around the low 20 handle, 22, 23. But that is well below another 20% to the upside before we retest the December highs on the volatility index. Once again, the declines in December were driven by concerns about the Fed meeting in the 3rd week of December. We had some nervousness going into the meeting itself, and then we rallied off the press conference and we on the equity markets, and of course we immediately retraced to the downside. Perhaps we could have the same price action in January. This time, however, folks, we've got the Fed meeting at the end of this month, and lots to consider before then for the broader market. If I bring you into the option trader window, let's take a very brief look at what we can do here. It's going to be this window. This one, here we go. Okay, let's take a look at our VIX. So we've popped 18% today on the highs. Let's assume that we're expecting the volatility to continue over the next couple of weeks. So a near-term time horizon. Well, we can look at the traditional monthlies, the Jan 18 and the Feb 15 expiry. If we go out to the Feb 15, we're taking a longer position on the volatility itself. So let's take a look at where we are if we were a buyer of upside call spreads on the volatility index. And we've tested the 22 handle today. In fact, we've broken above that. Let's assume we're a buyer of the 20 to 25 call spread. Okay, so we're going to go ahead and we're going to add this. It's a $5 call spread. So we can see we've added it to the quote panel on the top. So now we're going to be a buyer of this. We will make the maximum $5 if the volatility index is above 25 at the Feb expiry. That's 36 days away. But again, we have a lot taking place before then. As I've mentioned, we've got earnings season, we've got day-to-day moves in inflation and interest rate expectations. And as I've mentioned, perhaps the most important event for this month, for January, apart from the earnings, will be that Fed meeting at the end of the month, where we expect a revision to their expectations for interest rates. So the payoff here, if we're paying $1.70 mid-market for this, the payoff is potentially more than 2 to 1, close to 3 to 1, in fact, if we were able to take a long call spread position. $5 max value. What about our risk? Well, our risk is very simple. it's the premium that we're paying out. If we start to see the VIX move sharply below 20, that means a retracement, and we start to see the SPX bottoming out, then we could perhaps cut our risk at 50% of our cost. That is, of course, half of our $1.70 premium. So that's something to consider on the upside, where we are expecting volatility to remain elevated, but still near the low end of its range. Okay, something to consider when we think about the fact that we're not that far above the lows of 15, 16 from the end of last year. And we like that range between 15 and 20 because that is a range that you can work with, taking long or short volatility positions. Okay, so let me bring you back into the slides again. If I bring up the PDF, here we go. And we're bringing you on to the final slide now, which is where we get to open up the questions panel. Let's take a look at what questions we have here coming through, Andrew. So we have a question from Mohammed. He's asking what's the ratio between the VIX and the leveraged VIX, the 3x? Well, of course, that's very simply implying that there's a 3x move in the volatility index ETF relative to the move in the VIX. Okay, something to consider when considering those volatility ETFs, those VIX ETFs. Let's see, anyone else with questions coming through? Most of you folks today on our question of the day did agree that volatility in the VIX will break above the 40 handle at some point this year. And if so, then that potential setup, that VIX call spread that we looked at, where we are a buyer of the VIX 20 to 25 call spread, is a potential long volatility position. But remember, folks, the move has already started to take place. The VIX has moved from 17 up to 22 in just a couple of days. And now there may be a retracement, okay, or a leveling off of the volatility. So we need to think about that when timing of entry comes into play with our long volatility positions. And of course, on the other side, folks, let's also consider that if the volatility is peaking at or around these levels, then the volatility premium is elevated. And remember, as a seller of volatility premium, as a seller of out of the money put spread premium on the spiders or the IWMs or the Qs, a sell-off like this is where we start to look at the opportunity to capture put spread premium at elevated levels. Okay, the deeper the decline for the index ETF, the higher the volatility and the higher the premiums that we can capture as a seller of put spreads. So timing of entry works both ways for us when looking at that. Okay, now a couple of other questions. Evan is asking, how do we take into account buying VIX call options when you're buying options on the VIX futures? So Evan, that is a different approach where you're looking at the VIX futures. We're specifically looking at options on the VIX index with our positioning today. Of course, VIX futures have a different profile where they have a curve going out several days, several months, I should say. We did not include VIX futures in our positioning. We were simply looking at VIX call spreads on the VIX cash index. Okay, Evan, do feel free to reach out to myself after today's webinar if you do want to have a chat in more detail about that. Aaron is asking, do we recommend any resources for continued learning about volatility options? Well, of course, Aaron, we can think of no better place than our monthly webcast series with our friends here at Interactive Brokers. Folks, in fact, we have 2 webcasts coming up this month, January, with our friends at IB. Today's webcast on volatility, and the next event will be next Tuesday. That's Jan 18. That's a options-focused webinar on retirement accounts. Okay. Let's take a look. Any other questions coming through? Folks, if you do want to reach out to myself after today's webcast, you have my email on screen, but you can also reach out to myself if you do want to have a more direct chat about what's going on with the markets to start off 2022. It's been an interesting start certainly in the past few days. Let's see whether we can make some money from these kind of market moves, and if so, how we do that using option strategies in our portfolio.
What's the biggest risk to this market now? I mean, everybody's talking about, you know, potential for inflation, and it's a known fact that the Fed's going to tighten interest rates. But is that sufficient to drive volatility up and stocks back down? Isn't inflation good overall for stocks, Gareth?
Yeah. So, you know, think about it this way, folks. We had 3 consecutive years of gains for the major averages. Things don't always go up in price, very simply. But let's talk a bit more about this, about why are we starting off the new year on such a negative note? Well, folks, you know, interest rates, they're not going to stay at zero forever. The past 2 years, as I've mentioned, inflation has been on the tear. Inflation right now is at its fastest pace. It's growing at its fastest pace in several decades. At some point, central banks, including the Fed, need to step in and take action. Okay, because remember, the mandate of central banks is to manage inflation. They have an inflation target. If that inflation target starts to come up and bite them, then they need to step in and start hiking rates to balance both sides of the equation. So 3 rate hikes this year, that's going to be tough. But let's think about the longer term. There's always concerns for risk assets, for names that have recently gone public, new IPOs, for example, that are not making a profit. They're growth driven. They're not paying a dividend, of course. They will be most susceptible for obvious reasons. But there's a bigger story here, and that is the fact that the risk-free rate of return, also known as the 10-year Treasury yield, that if it starts to hit 2%, that becomes more attractive relative to other high-risk assets. And that's where there's another equation that you have to look at. And again, that's why I mentioned at the beginning of today's webcast that retail investors, they need to start paying more attention to what they typically perceive as the boring part of the market. Fixed income is certainly not boring when we have moves like what we've got in the past few days. Take a look at the 10-year Treasury yield. Watch it as frequently as you need to. When you start to see it stabilize, that should feed through to other parts of the market. But while it's selling off like it is today and over the past few days, that is going to reflect in risky assets like stocks.
Very good. Thank you very much, Gareth. Just to add to what Gareth has been talking about in terms of education, in response to Aaron's question, he's looking for any resources for continued learning about volatility options. Don't forget to check out from ibkr.com under education. Look to Traders Academy, and we've got a ton of good information there on options that will help bring you up to speed with what Gareth comes along here sometimes twice a month to talk to us about. So Gareth, thank you very much for joining us. I'll be in touch with you later in the week. And what day's your next webinar?
Our next event will be next Tuesday, January 18. That's an options focused webinar also, folks. We're going to be talking about option strategies in retirement accounts.
And don't forget, Monday is Martin Luther King Day here, which is what Gareth mentioned earlier, that we've got a long weekend. So yeah, it's options decay for long weekends, right, Gareth?
Indeed, 3-day time decay.
All right, very good. We'll look forward to speaking to you next week, Gareth, and I'll be in touch in the meantime. And thanks to everybody for joining us. And don't forget to look out for the link to the recording. You'll see that in a couple of hours from now. Thanks again, Gareth.
Thanks.
All right, bye for now.